You can buy a property all cash if you have enough money in your bank account. You can use equity partners. So if you want to buy a $150,000 property, you and 2 other people might front $50,000 each, and now you 3 are equal partners in this property, and you're going to share in the profits, in the rental profits, and when it comes time for you to sell the property, assuming that you make any money. And then you can use debt, where you can borrow money and pay this money back plus interest. And the way you can get this debt is through a bank, or you can do a land contract, which is when the seller of a property gives you the cash to buy their home. If you're like most people and you don't have all the cash in your bank account to buy a property, then you're gonna have to do one of these 2. And these are 2 things that you wanna start preparing for before you actually start looking at properties, because you wanna make sure you have the cash ready when it comes time to actually close. Like if you're gonna go get debt and you wanna borrow this money from a bank, your bank is gonna wanna see your income statements for at least the past 2 years so they can see that you have stable income. They're gonna wanna look at your credit score. If you wanna get the best rates, you wanna have a minimum of a 760 credit score, and they're gonna want to see your experience and your reputation. So the bank wants to see that you are a safe investment for the bank's money. A land contract, on the other hand, is when you want to buy this property right here, and you tell the seller, okay, I want to buy this $150,000 property, but I can't qualify for a loan. Either I don't have a good credit score, or I don't have enough income to show the bank, or whatever. I can't qualify for a loan from the bank, and so I will give you, the seller, $10,000 today, and in exchange, you hold back a note, a loan, for the remaining $140,000. So the seller will only get $10,000 today. That's what you give them. And then every month after that, you're going to pay the seller interest on this $140,000. And so the term typically on a land contract is usually 5 to 10 years. It's not usually a 30-year term like you see with banks, because these sellers want to get their money. And the interest rate you're going to pay on a land contract is typically higher than what you're going to pay if you got a loan from the bank, because the seller understands that if you could get this money from a bank, then you wouldn't be asking the seller for a land contract. So a land contract is an easier way for you to get money, but you got to pay an extra fee for it. And one thing that people like to do is maybe you can go buy this home, use a land contract to get it, and then once you're ready, you can go to the bank, refinance this home. That way the seller can go out of the picture, you pay off the seller, and now you're paying this lower interest rate to the bank. But the thing you got to be aware of here with refinancing is if property values go down, then it becomes harder for you to refinance. So you just got to understand the risk. And the thing about debt that you have to understand is the more debt that you take on, the more risk that you take on. So I want to make sure you understand that when you're buying this property, you're buying cash flow, you're not just buying a headache. And so you don't want to take on too much debt. This is one of the things that people get really excited about in real estate. Is there's this whole industry of people promoting the no money down real estate, where you might do something like buy this $150,000 property where the bank is going to give you 80%. They'll give you $120,000, and they'll say get the other $30,000 from the seller through a land contract. So the seller gives you $30,000 because they don't need all that money today. You pay it off over time, and then the bank gives you the other $120,000. So you bought this property with no money down, and now hopefully you can make a profit. And if property values goes up, that's all your money. Now, while this sounds great in theory, it also comes with the most risk, because if your tenant stops paying, or if your tenant damages the property, you have no skin in the game. And if you don't have money to take care of that and to cover your costs, now you're going to be the first one to go underwater and get the property taken away from you by foreclosing on the property, because the bank or the seller is going to ask for the property back. So debt is a tool, and it can be a good thing, but too much of a good thing can be a bad thing. So if you take on too much debt and the economy slows down, you're going to be the first one to lose everything. Now, if you come to equity, this is where now you're going to have partners in the deal. There's a couple ways that you can do this. In some instances, you're going to see that you have doctors or attorneys, these high income people who might have a lot of money but don't have the time to go and invest in the property. You can go to these people and say, hey, give me 15% equity in a deal and we'll work on deals together. So you go out, you find the properties and you manage them and you make sure that they're profitable. And this cash provider, this rich person, is getting 85% of all the profits. You get 15%. So you're managing the deal. You don't have to put in any of your own cash, but you get 15% equity. Or the alternative is you find a couple partners, you want to buy this $150,000 home, you all put in $50,000 each. You're equal partners in this instance, and so every time you make profit with your rent, you guys split the profit, 1/3, 1/3, 1/3, and when it comes time for you to sell the property, you share the profits 1/3, 1/3, 1/3. You can compare that to debt, where in this instance, let's say this property sells for $1 million. Okay, in this instance, the bank and the land contract owner are only gonna get whatever money they were in contract to get. So they're only going to get this $150,000 plus interest. They don't get any of the profit. Here with the equity holders, you only get a third of the profits because you only own a third of the property. When you buy a property with cash, then it's simple. You're just using your cash to buy the property. If you are a cash buyer, here's a little hack that I've used in the past that you might like. So if you want to buy this $150,000 home, what you can do is you can go to the closing table and you can buy the property for $150,000. But one thing that you can do is, let's say you're buying this property through an entity. I'm going to talk about this in just a minute. Now, instead of you depositing $150,000 into this entity and then buying this home, what you can do is, instead of you depositing it into this account, you can loan this money to your account. So now this entity that you own, I'm going to talk about this legal entity in just a second, but you own this entity that owes a loan to you. So now when you buy this property, you still have to make loan payments, and this loan payment goes back to you. So now your real estate investment has more of an expense because you have to pay interest, but all that money is going to you. So you get a bigger deduction and the interest tax break. Now, although I am an attorney, I'm not your attorney. So if you have specific tax questions or legal questions, talk to a professional in your area. This brings me to number 6, understanding the legal side of real estate, which means you got to understand what an entity is, a real estate entity, understand real estate insurance, and having a real estate attorney on your side. So when I buy real estate, I never buy real estate under my own name. Like, I don't actually own any real estate. I own real estate companies which own real estate. So the way it works is like this. This is me, and you know, I gotta draw me a nice mustache. I own this entity right here. Let's call it JS Real Estate. So I own JS Real Estate. This JS Real Estate might own this home right here. I don't actually own the home directly, because if I own the home directly and something bad were to happen, let's say a tenant lived in here and they slipped and fell in the bathtub because they said the bathtub got too slippery when the water was on, true story, and then they sued me. If I own the property, then they'd be able to come after me and my personal assets. But if this property is owned by JS Real Estate, then the most they can get, assuming that insurance doesn't cover this lawsuit, the most they can get is whatever this entity owns. And so this entity that I have, in this case, it might be an LLC. You got to ask an attorney in your area for what's best. But in most instances, LLCs are the best way to go. This entity is kind of like a barrier or protection that protects you and your personal assets from lawsuits and anything bad going on with your property. There's a saying in the real estate world that if you are a real estate investor and you haven't been sued yet, then you haven't been in business long enough. I mean, this is just the reality of being a real estate investor, especially in the United States, because you can be sued for anything. Like, I had a tenant sue my real estate company because they claimed that the bathtub was too slippery when the water was on. I already made a video on YouTube where I talked about that, so if you want to watch that and learn more about what happened, I'll link that for you in the description below. But this is where you got to understand, okay, what can I do to protect myself? That way I can protect my personal assets. And the way you can do that first is by creating this legal entity. The second thing you want to do is have real estate insurance. This real estate insurance is there kind of as the first shield before the entity, because this real estate insurance is there to protect you from anything bad happening. Like if a tenant slips and falls, or if the tenant sues you, first thing they're going to do is go after your insurance. So this insurance is there to protect you from lawsuits, and it's also there to protect your property, because if this property gets burned down or something bad happens to the property, that's where insurance is there to protect your assets. So insurance is your first line of defense. If the insurance fails, or if they don't cover you for whatever reason, this is where your entity is your second line of defense to protect you and your personal assets. The third thing that you want to make sure you have on your side throughout the entire real estate process is a real estate attorney. From the minute you start negotiating deals in real estate, you want to make sure you have a good real estate attorney on your side, because they're going to help you review your purchase agreements. They're going to help you review your due diligence. They can help you negotiate the contract with your contractors, and they can help you deal with city inspectors. You need to have a good real estate attorney on your side. I know they can be expensive, but it's a small price to pay today that can save you a huge headache in the long run. You want to make sure you have a good attorney that specializes in real estate. You don't want to just get a general attorney. I'm telling you this from experience because I am an attorney. There's a lot of kind of complexities and little things involved in real estate. So you want to make sure you have an attorney who's very familiar with real estate, not just a general attorney, because they can protect you from huge headaches in the future. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.